Welcome, folks. I had some issues with my corporate finance class in terms of the internet. I hope the issues are resolved. So if you're having trouble seeing my slides or my audio is breaking up, let me know. I'll turn off my video because that seems to help a little bit, at least, in keeping the session going. So, but unless you let me know, I might have no idea. I might continue to talk. So just put up your hand if something is going off and let me know. Okay, so let's get started. It's time. Today we're going to continue our discussion of pricing, and as with every other class, we're going to start with the usual, right? The start of the class test. So let's start with a multiple that we will see sometime today. We talked about PE ratios in the last session. Let's talk about price to book ratios. Right? Price to book ratios are widely used. Many value investors swear by them. And let's say you're looking at three companies in the same business. The cost of equity is 10% for all three companies. Company A has a return equity of 12%. Company B has a return equity of 10%. Company C has a return equity of 8%. I have a very simple question. Same business, same cost of equity, three different returns on equity. Which of these three companies is most likely to be trading at below book value? Prachi, what do you think?
I feel ROE 12%.
The cost of equity is 10%, and the ROE is 12% for company A, 10% for company B.
Yes, I think company A. I mean,
company A will trade at below book value or above book value.
Not sure. I was going by ROE exceeds cost of equity.
And is that good or bad?
Let me see. So if ROE is high, not sure, Professor.
The ROE is high. They're making more than you want them to make.
Right.
That's a good thing. And if it's a good thing, you're going to pay a higher
Maybe
price.
High. Yeah.
So
the other one then, company C.
So company C will have the lowest price to book. And today we're going to actually make that more concrete, which is when you see companies trading at below book value, the first thing to check is their ROE. So when you see a bank trading, and you're doing an Indian bank, right, Prachi? Is that your project? And you look at Indian banks, a third of them traded below book value of equity. And if you look at what they share in common, it's either because they have negative returns on equity or terrible returns on equity. Now, if you were trying to decide if return equity is a good measure of best managed, then obviously the highest return equity company is the best managed company, and the lowest return equity company is the worst managed. But I want to give you a cautionary note here. Let's assume that company C decides to admit to its screw-ups and does a massive write-off. You know, companies do that all the time. They make mistakes, they write off. They write off half their book value of equity. Overnight, what's going to happen to the return equity? That write-off is a one-time deal. The return equity is going to double. The 8% is going to become 16%. Not because the company is better managed, but because they've written down. So one of the things you got to be wary about when you look at both return equity and return on capital is you can have a high return on equity for a company that's a terrible company if it takes enough write-offs along the way. Its price to book ratio will also be high because its book value of equity has been written down. We might also get a chance to talk about revenue multiples, where you look at multiples of revenues, and let's say you decide to pick companies based on revenue multiples. Well, whether the revenue multiple is low or high. And you're trying to look across retail companies. And if you pick companies based on low multiples of revenues, the company's trading at low multiple of revenues, holding all its constant, you're looking at the retail sector, which of the following companies is most likely to look cheap to you? It might not be cheap, but look cheap because they're trading at low multiples of revenues. Department stores, discount retailers, luxury retailers, or should it not make a difference? I mean, the question I'm asking is, what is it that drives multiples of revenues? What kinds of companies trade at low multiples of revenues? And I'm giving you these three different retail groups. What is it you're going to focus on? If I wanted to focus on a metric, what metric in these companies is going to best explain the revenue multiple? With price to book, we saw it was return equity. I'm saying, what's the equivalent revenue? Sergio, you want to try?
I'm not quite sure here. My guess is that like discount retailers.
And what is it? You're absolutely right. They will trade at the lower multiple of revenues. And what is it about discount retailers? Even if they're ones as good as Walmart, what is it about discount retailers that will keep the revenue multiple low?
Yeah, so their margins are tiny.
Tiny. Exactly. You got it. One of the things we're going to talk about today is what I call a companion variable. What a companion variable is, whenever somebody throws a multiple at you, the companion variable is the first question you ask when somebody throws a multiple. So when somebody says this stock is cheap, it trades at half a book value, your question is, what's your return on equity? When somebody says this business trades at half of revenues, it must be cheap. The question asks them, what's your margin? The key to successful pricing is you're looking for mismatches. What are mismatches? A company that trades at a low multiple of revenues and has a high margin. A company that trades at a low price to book ratio and a high return on equity. We're going to be on that search constantly today. But it's again a search that's driven not so much by theory, but by the data and by statistics. So let's go back to where I was last session, and we were talking about PE ratios. I didn't mean to do that. We'll come back. We're talking about PE ratios, and we talked about PE ratios being different across time, across. No, I don't know what you're even saying, but my page has disappeared here. So today I'm going to start on PEG ratio. It'll come back in a minute, so sorry. I'm going to start with what I call PEG ratios. I don't know whether you've ever heard of PEG ratios, but PEG ratios, again, are a fairly recent multiple, something you wouldn't have seen 40 years ago. And here's where they were born. Portfolio managers adopted this low PE ratio credo from Ben Graham, and old-time value investors said, buy stocks with low PE ratios. And in the 1970s, Peter Lynch was given a fund to run. It was the first growth mutual fund, Fidelity Magellan. And he realized that focusing on PE ratios, you never were able to find growth companies. Growth companies don't trade at 6 times earnings, 8 times earnings. So he said, we've got to create something that's a composite that brings in your growth rate. So he didn't directly create it, but he contributed to creating this ratio called a PEG ratio. A PEG ratio, here's what you're doing. You're taking the PE ratio and dividing it by the expected growth rate. So let's take an example. Let's say you have a stock that's trading at 20 times earnings. That's a pretty high PE ratio, right? It's close to me. If its growth rate is 25%, I take the 20%, 20 PE and divide by the 25 growth rate, I get a PEG ratio of 0.8. So basically I'm dividing the PE by the growth rate, and the lower the PEG ratio, the cheaper the stock. So lots of analysts, especially in tech sectors and high growth sectors, use PEG ratios. I'll tell you upfront that I think the PEG ratio is an abomination, a ratio that creates really serious problems for you, and I'll talk about why. But you can see the allure, right? I've brought in growth, I've controlled for growth. In fact, many analysts who use PEG ratios say, look, I don't have to control for growth, it's in my ratio. So to try to address that question of whether growth becomes a non-factor when you do PEG ratios, I decided to do something I did in the context of PE ratios. Remember I said, you give me a multiple, I can always tell you the variables that drive that multiple by going back to a discounted cash flow model. I went to a 2-stage dividend discount model. Again, it's the same model you saw a few pages ago with the PE ratio. I divided both sides by the earnings and the growth rate. So I ended up with an intrinsic value equation for the PEG ratio. And here's what I saw. The PEG ratio for a firm is a function of its cost of equity, its payout ratio, and its growth rate. In other words, by dividing PE by the growth rate, growth has not gone away. In fact, it's become much more complicated. One of the things I want to point to is when you do a PEG ratio and you try to control for growth, it gets really, really, really messy. Because I can't even tell you which direction the effect is going to be until you tell me what the PEG ratio of your company is. So let me again set up a very simple proposition. I'll back this up. Holding all else constant, riskier companies should have lower PEG ratios than safer companies. Why? Because it's the same growth rate, higher risk, lower PE ratios. So that's going to come up. And dividing PE by the growth rate doesn't neutralize growth. It just makes the relationship much messier. So I'll go back to that hypothetical example I did with PE ratios and use it to illustrate both of these propositions. So here's a company, 25% growth for the next 5 years, 8% thereafter, exactly the same company we did before, cost of equity of 11.5%. I go to the PEG ratio equation, I plug the numbers in, I come up with a PEG ratio of 1.15. So given this company's growth, payout, and cost of equity, I would expect the PEG ratio to be 1.15. And as with PE ratios, I can now ask what if questions. What if the risk is different? What if the growth is different? Let's try that. Let's start with the easy one and the one where I can give you a fairly clear sense of direction. Holding all its constant, as I increase the risk in the company, the PEG ratio decreases. For a given growth rate, riskier companies will have lower PEG ratios than safer companies. You see why? Because for any given growth rate, you're willing to pay a higher price if the company is safer. One of the things you often see in tech company equity research reports is the analyst will compute a PEG ratio for his or her tech company. Let's assume it's Cisco. They'll come up with a PEG ratio, and they'll compare that PEG ratio to the PEG ratio for the S&P 500. So let's say the PEG ratio for Cisco is 0.9, and the PEG ratio for the S&P 500 is 1.05. They'll say that shows you Cisco is cheap because look, its PEG ratio is lower than the PEG ratio for the market. See the flaw in that? Cisco is a riskier company in the market. It should have a lower PEG ratio. If you're going to compare PEG ratios across companies, you need to make sure they're all of equivalent risk, because if you have safe companies and risky companies, the risky companies are always going to look cheap on a PEG ratio basis. And within software, I think you got to be really careful, because there are some software companies like Adobe that are mature money machines, and there are other software companies that are much riskier growth machines. So you can't compare PEG ratios across those companies and expect to make any sense of that difference. PEG ratios are also affected by how efficiently you deliver growth. Now, one of the ways you can measure that is what's your payout ratio for any given growth rate. And in this case, as I retain more of my money. So basically you can see the retention ratio is the percentage I maintain. You can see my PEG ratios reflect that if I'm more efficient in delivering growth, I will have a higher PEG ratio. But here's where PEG ratios really fall apart. So riskier companies have lower PEG ratios. Companies that have higher returns on equity will have higher PEG ratios. But when I change the growth rate, I got a graph that makes me really, really nervous. And here's why. So here what I've done is taken that hypothetical company and changed the growth rate. Initially, as growth goes up, the PEG ratio goes down. So usually as companies, because P ratios don't scale up with growth, but there's a point at which it starts to turn around. It's like almost a U-shaped graph. Not quite U, but you can see that. You see why this makes PEG ratios really messy to use? Because I can give you the cautionary notes. Riskier companies, be careful. PEG ratio will be lower. Higher return on equity companies, be careful. The PEG ratio will be higher. But if you said higher growth companies, what should I expect to see? I really can't tell you. This is the fatal flaw in PEG ratios, because controlling for growth becomes almost impossible to do because I don't know which direction it's going to cut in. So I know people like to use PEG ratios. They think it gets them away from their problems. But take it with a grain of salt, especially when people are comparing PEG ratios across companies. Different risk matters, the way you deliver growth matters, and growth rates continue to be a player in this game in very complicated ways. Which brings me to price to book. Okay? By now, you should start to see a pattern. Whenever I have an equity multiple, what do? I go back to an equity discounted cash flow model. In this case, a simple equity discounted cash flow model, dividend discount model. I divide both sides by the book value because I want a price to book ratio. And guess what? Like magic, I get the variables. On my left side, I get price to book. The right, I now have return on equity, payout ratio, cost of equity, and growth. 4 variables drive the price to book ratio. 3 you saw already with PE ratios, cost of equity, payout, and growth. But now in addition to all of those, you have return on equity. As you go through every multiple, this is a process we will repeat. We will identify the variables first before we use them. So the price to book ratio of a firm is a function of the return on equity in the firm, the payout ratio, the cost of equity, and the growth rate. But when we did fundamental growth, remember we did this way back? Remember I wrote the growth rate as a function of your payout ratio and your return on equity. In fact, it was the retention ratio times return on equity. If I plug that version of growth into my price to book ratio, I come up with a very nice variant on the price to book ratio. It's actually very intuitive. The price to book ratio for a company is the return on equity of the company minus the growth rate divided by the cost of equity minus the growth rate. So take a look at that equation. Remember that example we started the class with where you had 3 companies, one with a return equity of 12, second with a return equity of 10, and the third with a return equity of 8. And the cost of equity for all 3 companies was 10%. If you use this equation, here's what you're going to see. The company with a return on equity of 10% will always trade at a price to book ratio of 1. Its market cap is equal to book value. The company with a price to book ratio with a return equity of 8%, lower than the cost of equity, will trade at a discount on book value. And the company with a return equity of 12% will trade at a premium. You tell me your return equity as a company, I should be able to tell you whether you trade above book value or below book value. There's this notion, I don't know how deep it is among some value investors, that if you can get a stock at less than book value, you're somehow getting a bargain. That must be based on the presumption that somehow you can liquidate the company and get book value, but you're not going to be able to do that. The hidden variable that best explains why companies traded below book value is the return equity. Now, since we're on book value multiples, might as well look at the enterprise value variant of price to book. So in price to book ratios, I take the market value of equity divided by book value of equity, right? There's a variant of this that covers the entire company, where I take the enterprise value of a company and divide by invested capital. Enterprise value being the market value of all operating assets, invested capital being the book value. You know what drives the enterprise value to invested capital? It's a return on capital and the cost of capital. In fact, compare this equation to what we saw just a couple of pages ago. I'm sorry, the previous page. The price to book is a function of return on equity and cost of equity. The enterprise value to invested capital is a function of return on capital and cost of capital. Stay consistent. So if you're looking at enterprise value multiples, ROE will never enter the picture. It's going to be ROIC. Cost of equity will not be the player. It's cost of capital. And the same thing that I said about price to book applies here as well. Companies that have returns on capital that exceed their cost of capital should trade at premiums on their invested capital. And companies that earn less than their cost of capital should trade at a discount. Any questions about book value multiples? So book value is taking the accounting number and you're using that as your base in your multiple. And what drives that multiple will be the accounting return on that base book value, whether it's return on equity for equity or return on invested capital for invested capital. That's going to be the magic ingredient that explains why some companies trade at huge premiums at book value and others can trade at big discounts. Which brings me to EV to EBITDA. As I said, it's most widely used, perhaps the most widely used multiple in the world now in equity research. And it's a little complex. It's not as easy as EV to invested capital, but I'm going to go through the same process. It's an enterprise value multiple. So I'm going to go back to a simple enterprise value model. Free cash flow of the firm divided by cost of capital minus the growth rate. In fact, I'm going to expand out free cash flow of the firm to make my life simpler. I'm not doing anything different. Free cash flow of the firm can actually be written as EBITDA times 1 minus T. Trust me, I'm not changing the free cash flow of the firm equation, plus tax rate times depreciation minus CapEx minus change in working capital. If I take that equation, divide both sides by EBITDA, I can't come up with the drivers of the EV to EBITDA multiple. Let me list them out. The EV to EBITDA for a company is going to be a function of its tax rate. So when we did price to book or price earnings, how come we never cared about taxes? I didn't ask you what the tax rate is. Why is it that when we go to EBITDA multiples that I start to worry about taxes? Jesse, what do you think? Why is tax rate entering the game with EV to EBITDA, but was not an issue when I did price earnings?
Yeah, I mean, earnings already incorporates the taxes.
Exactly, right? PE ratios use net income. Net income is already after tax. If you pay a high tax rate, your net income is lower, so I don't have to worry. EBITDA is before taxes. Let's take an extreme scenario. Let's say you're in a country where the marginal tax rate is 98%. I would pay a lot less for the company there because your EBITDA can look huge, but by the time the government gets 98% of your taxable income, I'm left with far less. So first thing that's going to drive your EV to EBITDA is your tax rate. Higher your tax rate, the lower your EV to EBITDA. The second is expected growth. Holding all its constant, higher growth companies should have higher EV to EBITDA, which kind of makes sense in almost every multiple. The third is your cost of capital. If you're a risky company or you're in an emerging market with a higher cost of capital, I should expect you to trade at a much lower multiple of EBITDA. And finally, I want to get a measure of how efficiently you're delivering growth. How much are you reinvesting to get that growth? And the less you have to reinvest, remember CapEx, depreciation, working capital put together is reinvestment. The less you have to reinvest, the more I'm willing to pay for your company. One of the things I'd like you to think about when we go through pricing is if somebody's trying to sell you a stock using this multiple, I want you to go down this list. So let's say I'm trying to sell you a company, say this company is cheap, it's trading at 4 times EBITDA. First question you're going to ask me, what was your tax rate last year? If I say 75%, say, that explains it. Second question I'm going to ask is, what's your cost of capital? Where are you located? Maybe I'm a Nigerian company with a 15% cost of capital in dollar terms. What's your growth rate? Maybe my growth rate is negative. I'm a company that's shrinking. That could explain the low EV to EBITDA. Or maybe I'm reinvesting huge amounts to get this paltry growth rate. Maybe I'm reinvesting 80% of my income to get a 3% growth rate. So remember what I said at the start of pricing. Most companies that look cheap deserve to be cheap. So when a company is trading at 4 times EBITDA, 90% of the time, there's a good reason why it trades at 4 times EBITDA. But the 10% where it's being unfairly priced at 4 times EBITDA is the one you want to latch onto. And asking these questions will get you there. So as with PE and PEG ratios, let me set up a hypothetical company. A company with a tax rate of 36%. Its CapEx is 30% of EBITDA, depreciation is 20% of EBITDA. So net CapEx is about 10% of EBITDA. The cost of capital is 10%. And let's ignore working capital and make our life simpler. If I plug the numbers into my EV to EBITDA multiple, this equation that you go saw on the intrinsic EV to EBITDA for this company, based on those inputs, is about 8.2. So this company should trade at roughly 8.2 times EBITDA, given those characteristics. And as with PE or PEG, I said, what if? What if I had different tax rates? And you can see as my tax rate goes from 0 to 50%, my EV to EBITDA goes from 14 to 6. Same companies, same numbers, much higher tax rate, much lower EV to EBITDA. If you're the telecom analyst in Europe, and you have Irish telecom and German telecom in your universe, you got to compare them. German telecom is always, Deutsche Telekom is always going to look cheaper relative to Irish telecom simply because of differences in tax rates across countries. If I change my net CapEx, I'm reinvesting more to deliver the same growth rate. The more I have to reinvest, the less my EV to EBITDA. So if you have 5 companies and one is investing huge amounts in CapEx and one is investing almost nothing, you should expect the company that's investing huge amounts in CapEx for the same growth rate to trade at a much lower EV to EBITDA. And finally, I looked at return on capital at companies. The higher the return on capital, the higher the EV to EBITDA for the company. So let's design a perfect undervalued company on an EV to EBITDA basis. We want it to have a low EV to EBITDA. We want to get it cheap. You want a high tax rate or low tax rate for this company? If it's a perfect company to buy, what do you want it to have? Nathan? You're getting it at low EV to EBITDA. Do you want a low tax rate or a high tax rate?
I want a low tax rate.
You want a low tax rate, right? Otherwise, you explain away the EV to EBITDA, but now you get it right. You want a low tax rate, you want a low cost of capital, you want a high growth rate, you want a very low reinvestment rate, great returns on capital. You're saying, what? No chance do I have looking? Again, The advantage of having something like S&P Capital IQ is you can look for that mismatch. Find me companies that trade at less than 10 times EBITDA, have returns on capital that exceed 20%. Maybe you might get only 5, and you look at 5 and 3 of them you throw away because there's something weird going on. But you have 46,000 companies to look at. Maybe you'll find 2 where you get this mismatch. Which brings me to revenue multiples. So let's see where we are in terms of companion variables. P, it's growth. Price to book, it's return on equity. EV to invested capital, it's return on capital. EV to EBITDA, it might be tax rate, or it might even be, reinvestment rate. You think, what about revenues? I think Sergio latched on to the driver of revenues. It's margins. In fact, if you don't believe me, I plug numbers into this enterprise value equation. And again, all I did was took a DCF model. You can see the EV to sales multiple for a company is a function of 4 variables. It's operating margin after taxes. It's reinvestment rate that measures the efficiency of growth, the cost to capital, a measure of its overall risk as a company, and its growth rate. You give me the reinvestment rate, cost to capital, growth rate, and after-tax margins for a company, I can tell you whether it should trade at 3 times revenues or 50% of revenues. Yesterday, I was watching Shark Tank, and there was this lady trying to sell a business to the sharks. And she had revenues of 600,000. She was selling something to do with weddings, some patterns, like an old Shark Tank episode. Her revenues were 600,000. She made no money, and she valued a company at 2 million. So I asked her, why 2 million? She said, companies usually trade at 3 to 5 times revenue. She just pulled that number out of her rear end, I think, 3 to 5 times revenues. Really? It's that easy? For a company to trade at 3 to 5 times revenues, you know what the margins will need to look like? You'd have to have like 30% margins. So could a company trade at 3 to 5 times revenues? Yes, if it's a company that has 30% margins growing at 20% a year. Most companies trade at revenues, 1.5 times revenues, half of revenues, depending on what kind of margins they can deliver. So here's what I'm going to do. I'm going to use the EV to sales ratio as a way of valuing a brand name. Remember that early in this class, we talked about the value of a brand name comes from pricing power. And I promised you I would return to this idea and give you a way of valuing a brand name. So let's say I come to you with a brand name company and I say, can you tell me the value of just my brand name? Now, why might a company want to just value just its brand name? What might be the reasons a company might want to know the name of just its brand name? Hakan, do you have any possible reasons?
I think it's the story side of the value of the company.
Okay, it could be this: I want to tell a better story and I want to tell the world, this is how much my story comes from my brand name. I'd like to know what that value is. Can a company sell its brand name? Yes, there are some companies that actually sell away the brand name. You're selling away the franchise here, but if you get a high enough price, you're willing to do it. But you know what the most common reason companies want a value for their brand name is? It's accounting rule writers. In much of the world now, accounting rules are asking companies to put brand name on the balance sheet. And I think it's an extraordinarily dangerous move, and you're going to see in a moment why. Can I value a brand name? Yes, I'll give you the kind of structure I would use, but I'll make an honest admission. Doing this is easier in some companies. It's going to be horrifically hard in others. And here's what I'm going to do. I'm going to come up with an EV to sales ratio for a brand name company. And guess what brand name companies have? They have sky high margins. I'm going to build in those sky high margins and give you an EV to sales. And then I'm going to revalue your company if you lose your brand name. We'll say, what happens if I lose my brand name? You become a generic company. Generic companies have pencil thin margins. I'm going to give you pencil thin margins and give you an EV to sales ratio. And the difference then between the two will give me the value of a brand name. It sounds incredibly abstract. So let me make this specific. Probably 20 years ago, got a call from somebody went through this class who works at Coca-Cola, and he said, would you be willing to come to Atlanta to Coca-Cola and talk to our top management team about the value of our brand name? And you can see why, right? Coca-Cola is a company that's its value comes from its brand name. In fact, it was ranked, I think, the #1 brand for almost the last 4 decades of the last century. It's kind of lost its ranking there, but for a long time it was ranked as the #1 brand name in the world. So he said, everything we talk about here, we talk about in the context of a brand name. Would you be willing to come in and talk to our top management team? And I said, okay. So I showed up a few weeks later. The whole management team was kind of in the room. I presented my valuation of Coca-Cola using a traditional discounted cash flow model, return on capital, reinvestment rate, growth rates. And just to give you a sense of what drives the value of the company, it's these immense margins. Coca-Cola has after-tax operating margins of close to 16%. You know why the margins are so high? It's much higher than most other bottling companies because of something Coca-Cola did 40 years ago, which is they took their bottling operations, which are their capital-intensive, low-margin businesses, and they spun them off as a separate company. So be very careful. When you try to buy Coca-Cola in the US, if you're not careful, you might end up buying the bottling company, which is a horrific death trap because it's a low-margin business with one customer, Coca-Cola, who has complete bargaining power to decide whatever they want to do. So this was Coca-Cola, the company. So I said, high margins, high growth rate. I came up with a value of about 80 billion. I finished the valuation. And one of the people in the top management team was the head marketing, the marketing guru, put up his hand and said, you forgot something very important. So I'm wondering, what did I forget? Maybe I forgot a division, a geography. I said, what did I forget? He said, you forgot the fact that Coca-Cola has the most valuable brand name in the world. I said, okay, what do you want me to do? He said, you should be adding at least a 20% premium to your value. And I said, why? He said, because that's what we do at Coca-Cola is when we buy target companies in other countries with brand names, we value them and then we add 20%. I had nothing to lose. I said, just because you do stupid things doesn't mean I have to do stupid things as well. He said, don't you think our brand name has value? I said, it's the only thing in this building that has value. The syrup, who cares? The management team can come and go. I could take you and replace you with 12 people off the street. The brand name will still persist. He says, how come you're not adding the premium? I gave him my answer. And you could probably guess what the answer was, which is, it's already in there. Now, to kind of illustrate this already in their concept, I remember a commercial that used to run in the US. This was about 30 years ago. I haven't seen it in a long time, but I'm sure you can find it in the Google archives. It's a commercial for a spaghetti sauce, ragu spaghetti sauce. It's still around, but this commercial, here's how the commercial would run. There's this 45-year-old Italian gentleman who is dropping in on his mom's, at his mom's house for dinner. It's obvious he's a big time loser and he keeps dropping in for dinner every night. And he walks into his mom's kitchen and his mom is making spaghetti sauce. So in the commercial, she's stirring the spaghetti sauce. She's surrounded by empty bottles of ragu. So he says, Mom, what are you doing? He says, I'm making spaghetti sauce. He says, but you always make spaghetti sauce from scratch. How come you're using these bottled spaghetti sauces? To which her answer should have been, if you didn't drop in every night, I might make it from scratch, but because you could drop in every night, I've just gotten tired. But then he starts listing off the ingredients. And I'm not very good with spaghetti sauce. So if I throw in an ingredient that doesn't belong there, just take it out. I say, so that's not obvious. He says, where's the tomato? It's in there. Where's the oregano? It's in there. Where's the cayenne? It's in there. I'm Indian, I throw cayenne into everything. But basically, every ingredient he has, it's in there. It's in there. It's in there. If you do a good valuation, you should be like that Italian mother. Where's the brand name? It's in there. Where's the great management? It's in there. So I said, it's in there. He said, I don't believe you. This is what happens when you're marketing people in the audience. But I came prepared. I said, okay, let me show you how much of your value comes from brand name. And here I got incredibly lucky. I found a Canadian company called COTT, C-O-T-T. It's a company that makes generic products. In fact, it sells it sells millions of cans of soda. You say, I've never heard of it, because here's what it does. It makes the soda and it gives it to grocery stores to put their own name on. So if you're going to Pathmark, they let Pathmark put their name on it. They sell generic sodas. They're a generic maker of sodas. I said, okay, let's play a game. Let's assume tomorrow we all woke up collectively around the world with selective amnesia, and the only thing we didn't recognize was the red can and the word Coca-Cola. Your brand name has disappeared. You become a generic soda company. I said, what will happen to you? Let's keep your scale the same, but your margins will no longer be 15.57%. You're not going to be the front of the grocery store. You're going to be at the back. You're not going to sell for 50 cents a can. You're going to sell for 11 cents a can. And your margins will reflect that 5.28% margins. When you drop your margins, there are ripple effects. When you have lower margins, holding all its constant, you have lower returns on capital. Lower returns on capital, holding all its constant, you have lower growth. If you have lower growth, holding all its constant, your value is now much lower. I said, if you lost your brand name, your value would go from 79 to 15 billion. You want me to add a brand name value? I just did. I gave you a $64 billion brand name value because the difference between those two numbers is the value of a brand name. Now, this is easy to do in the context of Coca-Cola. Why? Because their only competitive advantage is brand name, right? You know, last year, the company that was ranked #1 in terms of brand name value, there's this outfit in the UK called Interbrand that ranks brand name values around the world. You know, the #1 brand name value, according to them, is they have no idea what they're doing, but let's take the ranking. You know, it was Apple. Could I do what I did with Coca-Cola with Apple? Or tell me what the problems would be if I tried to do with Apple what I did with Coca-Cola. First thing I need to do is find a generic company in what? Smartphones, computers. First thing is. Second, if you think about it, what I'm essentially doing is basically taking all of the competitive advantage of the company. That's what causes the difference in margins and returns and attributing it entirely to brand name, which in the case of Coca-Cola works because it's its only competitive advantage. But in the case of a company like Apple, it could be brand name, it could be the operating system, it could be styling, it could be distribution. I mean, there are multiple competitive advantages. The more competitive advantages you have, the more difficult it becomes to split them up. Does that bother me? Not in the least, because my job is to value a company. I don't care about how much of Apple's value comes from the brand name, how much comes from the operating system, because they're never going to split them off. I'm buying the company with all. And this is why I think accounting is on an ill-fated expedition, because accounting wants to split up these, they like to call them intangible assets, and put them as separate line items. And it's a task that is almost predestined to end badly. Because you can see with Apple, they're going to start making up stuff as they're going along. How much comes from the operating system? Can you imagine being the accounting firm given this task at Apple? The answer is you have no idea. Where does the operating system end and where does the brand name begin? Where does the brand name end and where does John Ive styling at Apple begin? I have absolutely no idea. And we're trying to keep them separate. So as you go through multiples, I'd strongly encourage you to do what I did even with the limit, like the 6 or 7 we looked at. If it's an equity multiple, go back to an equity valuation model, and you can isolate that, the variables that drive that multiple. You saw what I did with PE and price to book. You can do that with any other pricing multiple. If it's an enterprise value multiple, go back to a simple enterprise value model, and you can tell me what the drivers are. Free cash flow to firm multiple, EBIT, EBITDA, sales. So pick any multiple that you see and see if you can extract the variables. Not because you intend to use the equation, but because it gives you the questions to ask, right? If it's EV to sales, what's your margin? What's your return capital? What's your cost of capital? Because it allows you to then identify what combination of these variables creates your dream company. Any questions? So define, describe, analyze. Now we're ready to apply, right? Because you give me a group of companies, I know exactly what variables to control for, what questions to ask. And now the challenge becomes, given that I'm trying to value a company, what should I define as comparable companies? And you can see why that's a subjective judgment, right? Because you can stay narrow or you can go broad. You can look at only US companies, you can look at global companies, you can look at only large companies or only small companies. What is a comparable company? And conventional wisdom seems to push us into sectors, right? If you have a software company, we're told you can compare to only software companies. If it's a utility, we're told you can compare to only utilities. My pushback is why? Why can't I compare a software company to a utility? And you're saying, but because the risk is different, the growth, you're right, the risk is, what if I can control for those differences? Do you see where I'm going? If I can control for differences, you can make your sample much bigger and I can control for differences. Because embedded here, those two aspects have to be dealt with. So when you try to price your company, and remember, once you get your perfect DCF back, that's all that's left in your project is pricing your company. You're going to face this choice. What should I include as my comparable companies? And my suggestion is use your access to S&P Capital IQ. It's an incredibly powerful tool for coming up with this group. Because you're going to face a choice. Should I go with a small sample of companies that are more like my company, or a much larger sample of companies, which might be less, but I have the law of large numbers working in my favor? So I can take a US steel company and compare to 6 other US steel companies, or I can take a US steel company and compare to 150 global steel companies. I think the answer depends on what you plan to do with that sample. If you're just going to compare your PE ratio to the average of those companies, you should probably stay small and focused. But if you're willing to use more statistical tools to control for differences, you can go much broader. And when you think about controlling for differences, it's very difficult to do direct comparisons. But there are some sectors where this is what people used to do. For the longest time in the US, the auto analyst had a very simple task because he or she had only 3 companies to track for the last century. You know what they were? GM, Ford, and Chrysler. Basically, they compared them to each other directly. What is the growth? What's the margin? And the argument is they're so similar, what else do I need to do? The second is you tell stories, right? This company trades at a higher multiple of revenues, but that's because it has higher margins, got more growth. The third is whatever variable you worry about, you try to bring it into the multiple. That's what people do with PEG ratios. They said different growth rates. Let me just incorporate that in the multiple. But I'm going to push you towards something that I think is a lot more powerful. We have tools and statistics that were designed almost perfectly for what you're trying to do in pricing. Control for differences in growth and risk and payout. So let me try the storytelling route, and you're going to see very quickly why it's going to run into a bit of a roadblock. So 20 years ago, I pulled up the PE ratios for a bunch of beverage companies. Okay? So you can see them listed out. There's the trailing PE, and I've also given you 2 variables I've collected for each company. You're going to see in a minute why I've given you the variables: expected growth in earnings per share and the standard deviation in stock prices. So one is a measure of growth, the other is a measure of risk. So you ready? I'm going to put out a buy recommendation on 2 of these companies. And I'd like you to tell me what I might be missing in this buy recommendation. The 2 companies I'm going to recommend are a company called Todd Hunter, which I know very little about, and a company called Andre Wine. You've probably seen the commercials, usually come around Christmas, or even watching the commercial. It's champagne that's so cheap that even watching the commercial gives you a headache. It's really, 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 really cheap. So you see why I picked those 2? What is it that makes them attractive? They're trading at really low PE ratios. I'm a very naive analyst. I tell you to buy these 2 companies because they look cheap. I might be right, they might be cheap, but I've kind of given away why they might be trading at low PE ratios, right? Prithvi, what is it that makes Andre Wine and Todd Hunter look cheap?
Is it the low growth rate?
There you go.
Yeah.
There's a low growth rate, right? There's another company that trades at less than 10 times earnings. Is that at the very bottom? Hansen. You've probably drunk the natural sodas. There, the growth looks pretty good, right? Saying, this is good, I'm going to go buy Hansen. What's the thing that might hold you back? What is it that Hansen has that potentially makes it a more dangerous investment? It has a higher standard deviation. I'm not saying, again, you rule out the 3, but I'm saying in most cases, when you see companies look cheap, in this case, you've got Andre Wine and Hansen Natural, they look cheap. When you dig a little deeper, you can see that there's something that's out there that causes them to be cheap. Is it enough to stop you? Maybe not. And that's a problem with storytelling is, what do I do with this? You're not sure, but there are no slam dunks here. There's no company here that looks cheap and has high growth and low risk, right? Because that would be a perfect company. But none of the companies meet those criteria. So let's try another example. Let's assume you're comparing telecom companies. And I'm going to take you back in time to the 1990s when telecom companies around the world were being privatized. And the ADRs were being listed in the US. An ADR is just a foreign stock listed and traded in the US in dollar terms. So these were all ADRs, telecom ADRs traded in the US. The advantage of comparing ADRs is, at least in theory, they all should be following GAAP. And if I'm doing a PE ratio, I worry about how's the earnings per share being computed. The rules at least should be the same. So here's my ADRs, and you can see I've got Indosat, I've got Telebras, all the way to Korea Telecom, which is trading at 71 times earnings. And just again, I'm going to give away something that might be useful in your comparison. I give you the expected growth in earnings of these companies, all in dollar terms. So I got fired as the beverage analyst after my horrifically bad recommendations there. I land on my feet. I'm now the telecom analyst, but I'm still holding on to PE ratios. So I tell you to buy Indosat and Telebras because they're the only two telecom companies that are trading at less than 10 times earnings. But they also happen to be among the lowest growth companies at that point in time, and that worries me. You know what should worry me about Indosat and Telebras? Telebras was the Brazilian telecom company, and Indosat was the Indonesian telecom company. And this was the 1990s when emerging markets were emerging markets, really risky, and developed markets were developed markets. The reason I bring that up is you look at this list, it includes Swisscom. European telecom companies are obviously much safer. So here's where I am. Indosat and Telebras look cheap, but they also have low growth and potentially high risk. With storytelling, I'm trapped, right? What do? I go back and forth on the one hand, the other hand. So here's where statistics can help me. What am I trying to explain? Differences in PE ratios across companies, right? That's what I'm trying to explain. What are the variables I'm worried about? I'm worried about the fact that growth is different for the different companies, and also by the fact that some of these companies are emerging market companies and risky, and others are developed market companies and safe. Do you remember dummy variables in statistics? You know what a dummy variable is? Basically, a dummy variable takes on a value of either 0 or 1. So think of adding an Excel column with either 0 or 1. I'm going to create a dummy variable for whether a company is an emerging market company or a developed market company. I'm going to give it the value 1 if it's an emerging market. So Indosat, Telebras will have 1 next to them. Swisscom and Deutsche Telekom will have zeros next to them. So I'm going to have a third column, which is that dummy variable. So what are you going to do with that? I ran a regression. In fact, the coefficients got thrown off here. But when you run a regression of price earnings ratio against growth rates and this emerging market dummy variable, let's do some basic statistics. When you run a regression, what's the first thing you check? You check the R squared. Am I explaining anything? And the R squared is about 66%. Is that a good R squared? In my view, statistics classes ruin you for life because everything in statistics classes of R squares of 90%, 95%, nothing in the real world that's worth testing ever has an R squared that high. 66% is about as good as it's going to get in markets. That's pretty good. 2/3 of the variation is explained by the two variables. Let's keep going. What's a constant tell you? That's a base from which I'm going to build off. So it tells you nothing more than the level of pricing in this market, 13.12. That's what I'm going to start from. The coefficient on growth is 121. You're saying, what does that mean? Every 1% difference in growth rates across telecom companies translates into a 1.21 difference in PE ratio. So if you're a telecom company with a growth rate 5% higher than mine, your PE ratio will be roughly 6 higher than mine, 5 times 1.21. I've now taken the growth effect and actually quantified how much it will pay out in PE ratios. But here's the number that jumped out at me. Remember that dummy variable I created for the emerging market, 1 for an emerging market, 0 if you're not? The coefficient on that variable is minus 13.85. You're saying, what does that mean? If I compare two telecom companies in the late 90s, one is a developed market telecom company, the other is an emerging market telecom company with the same growth rate. The emerging market telecom company has a PE ratio 13.85 lower than the developed market telecom company. You're saying why? Because that's how much the market was punishing emerging market companies for being risky. When you enter pricing, you're no longer asking what should be, you're asking what is. So in discounted cash flow valuations, what should be the additional premium for? Here we're saying, let the market's going to tell us. In the late 90s, the market didn't like emerging market stocks. It was discounting them significantly. We wondered, how does this help me decide whether Indosat or Telebras is undervalued? But Telebras look cheap, right? It's trading at 8.9 times earnings. That's much lower than almost every other company in that group. But if I take the regression that I just showed you, 13.12 plus 121, so the coefficient, plug in Telebras's growth rate and the fact that it's an emerging market company into the mix, I get a predicted PE of 8.35. It's actually trading at 8.9 times earnings. Given its low growth rate and the fact that it's an emerging market company, my predicted PE ratio for Telebras is 8.35. It's actually overvalued, not undervalued. And I can take every company in my list, plug it into the regression and give you, these are my undervalued stocks and these are my overvalued stocks. I'm no longer just basing it on the PE ratio. I'm basing it on this predicted PE that factors in growth and risk into the PE. No, this is something, that you can work within an Excel spreadsheet. It's like a 2-minute add-on now. You don't even need to know how to run a regression. It's just taking that data analysis tool in regression in Excel and running it. But it's actually a very simple way in which you're bringing in controls into your analysis without just telling stories. Any questions on? Now, this is what's called a linear regression. If you remember in statistics, basically, I'm assuming a linear relationship. Is that always appropriate? Not necessarily. We're going to see that there are some times where you might want to modify this regression to allow for the fact that the relationship is not linear. You know what I mean by linear, where the steps are not always the same. So PE might go up with growth rate, but it might not go up at the same rate as the growth gets higher and higher. There are ways of adapting this regression to reflect it. But this is a very simple regression where I'm basically trying to explain PE ratios of the variables that worry me the most when I look at PE ratios. Let's keep building on this. Let's assume that I've now been fired as the telecom analyst. I'm just failing at every job I have. I've become the European bank analyst. And this is what my sector looks like. And with banks, a big driver of pricing is price to book ratios. You know why? The book value of equity at a bank actually means something because everything is marked to market. You can't give the excuses you gave with traditional companies. The regulatory capital guys watch it. So price to book ratios is widely used. So I have the price to book ratios for banks in 2010. I have the return on equity in the second column because, as we said, it's your companion variable. And I've thrown in a measure of risk as standard deviation. In fact, in hindsight, I wish I'd thrown in tier 1 capital ratio, some measure of risk that's specific to banks. So tell me again what you would like as your perfect combination. You'd like a stock with a low price to book ratio, but you also want that stock to have a high return on equity and low risk, right? So if I tried this on Bayerishi, hypoinvariance, whatever, it looks cheap, price to book, but then it falls apart. Its return equity is terrible and its risk is high. Let's say you don't like statistics, you don't like running regressions. Here's a very simplistic way of looking for bargains. Even if you don't like statistics, you should be able to compute median values, right? What if I told you the median price to book ratio across these companies is 2.07, the median return on equity is 11.82%, and the median standard deviation across these companies is about 22%. So I've given you the median. What are you looking for? Cheap stocks will be the ones that trade at low price to book. In this case, 2.07 is the median. You're looking for stocks that trade at less than 2.07. So everything from Bayerishi to Société Générale trade at less. So they trade at less than the median. But you also want stocks which have a return on equity greater than the median. In other words, they deliver returns on equity that are higher. So if you go back to the previous sample, there's only, I think, one stock with a return on equity higher than average, which is BNP Paribas. So it's got a price to book lower than the median, a return on equity higher than the median. And the standard deviation is 21.93. So what do I want? I want a stock with a standard deviation less than the median. Well, even Paribas falls apart because it's riskier than the average. Am I surprised? Not really. These are widely followed stocks. If I was expecting something to land in my lap, I was hoping it would, nothing does. In fact, Societe Generale looks interesting. Its price to book is lower than the median. Its return equity is slightly below, which is not a good thing. And its risk is close to the average. But you can already see that this is what equity research analysts end up doing, is because they're eyeballing the data, they start then stretching, they start making up stuff, because how far can you run eyeballing 20 companies, right? On one hand, the second hand, the third hand, you have all these different variables you're keeping in. And that's the advantage you get when you use tools like regressions. You're not replacing your judgment calls. You're just bringing in a tool that gives you more explicit direction on what to do with this. So here's what I did. I took that grouping that you just saw and ran a regression. R squared was actually awesome, 79%. And incidentally, with banks, price to book and return equity, don't be surprised to see these really high R squares because it explains a huge amount of the variation across price to book. The signs make sense. Higher return equity companies have higher price to book ratios, and higher risk banks trade at lower price to book ratios. You're saying, what are these numbers in brackets below? I'm remembering what my statistics professor said, which is when you run a regression, you have to make sure the coefficients are statistically significant. What does that mean? Well, in terms of T, I'll give you a very simple rule. I don't know whether you were given the same rule. A T statistic above 2 is statistically significant. So if I got a T statistic of 0.7 or 0.8 or 0.9, I'm going to say, look, nice regression, but it doesn't work that well. Statistically, it doesn't hold up. In this case, I have a regression that holds up. I can use it to get predicted price to book ratios for every single company. All I've done is taken the ROE and standard deviation and plugged it in and got a predicted price to book. So if you take Bayer-Rishi Heppo, price to book is 0.80, predicted price to book is 0.89. It's undervalued by about 10.6%. So all I'm doing is comparing the price to book to the predicted price to book. You look at the last column, that tells me which stocks are undervalued. And you know what, when you do pricing, roughly half of companies are going to come in under, half are going to come in over, because you're drawing the level based on what the market is paying. So be willing to use statistics and be creative in what you call growth, risk, and so for instance, with banks, and this is why I said it might be better to use tier 1 capital, maybe standard deviation in stock price is not the best measure of risk. Maybe as an analyst, when you look at a bank, what you worry about are bad loans. Maybe you put in bad loans as a percentage of total loans as your measure of risk. You can throw in whatever worries you at that moment, you could throw it in as a variable. Maybe you're looking at a sector where 3 companies might potentially be regulated in the next 5 years. You could throw in a dummy variable that says, for those companies, I'm going to put in a 1 for regulatory overlay and 0 for the rest of the companies. Whenever you make comparisons, whatever you worry about, you can bring into the analysis if you're creative about coming up with a proxy for it. In my corporate finance class, I kind of, I talked about ESG at the start of the class, and I talked about how I think it's become the most overhyped, oversold concept in business. And people throw out these things, stocks which are good make higher returns, stocks which are good trade at higher prices. Well, I mean, if you really want to test it out, if you're a believer in ESG, you got a tool you can use, right? Take a sector that you think ESG matters in. You now have ESG scores for companies. Throw the ESG score in. And if it is true that ESG makes you a more attractive company to market, here's what you should see. After controlling for growth, risk, and cash flows, stocks that are good, that score higher on an ESG ranking, should trade at higher multiples of earnings, higher multiples of book value, and it should show up in the coefficient. Researchers tried it right now. That coefficient is insignificant. There is no evidence right now that being good leads to a higher pricing, higher returns. Maybe that'll change and we can track it. But the way we're going to see that is by bringing in explicitly into the analysis and asking the question, does it pay off? Does it result in a higher multiple? Does it provide higher growth in earnings? Whatever it is that you're trying to explain. Okay. Any questions? So far I've looked at sectors, right? We looked at beverage, we looked at telecom, we looked at banks, I looked at PE ratios and price to book ratios. Let's assume that I want to look at not a sector, but a group of firms. In this case, let's the 100 largest firms in January 2010. So what I did was I computed the price to book ratio for every firm and the return in equity for every firm. So I have 100. So think of the Excel spreadsheet. I have 100 price to book ratios, 100 returns in equity. Then I did a scatter plot, nothing magical, but I put them all in a plot. You're saying, what are these lines that I've drawn through? You know what those are? Those are my regression lines that I drew through by regressing price to book against return equity. The middle line is my regression line. The two outer lines are the confidence intervals because there's some noise in my regression. I'm trying to find the cheapest and the most expensive companies among the 100 largest market cap companies. So let's see if we can spot this in the graph. So I have these two lines and there are a couple of stocks that fall above the line and a few stocks that fall below the line. So here's my first question. These are the 100 largest market cap companies, price to book against return equity. Which of these stocks, the stocks above the line or below the line, are my overvalued stocks and which ones are my undervalued stocks? Where would you see the over and out? Dave, you want to try? Where would my undervalued stocks show up on this graph?
Well, if they're above the ROE line, they should be relatively undervalued. So like INFY, Google.
Those are undervalued or overvalued?
Actually overvalued, sorry.
They're overvalued, and the ones below, they are undervalued, which in this case are ExxonMobil, Nokia, and ConocoPhillips. Now do you see why you don't rashly rush out and just buy the undervalued and sell the overvalued? Let's take a look at the overvalued. Infosys, Gilead, and Google in 2010. Look overvalued on a price to book versus return equity. But remember, there are other dimensions that drive price to book, right? You know, the key missing dimension here is, what about growth rates? Those three companies happen to be among the highest growth rates. Maybe that explains why the price to book falls above the line. Conversely, if you look at least two of the three companies that I have as undervalued are oil companies. Maybe the reason they look undervalued is because the oil price has dropped since I computed their most recent return on equity. Again, I'm not trying to explain away mispricing, but I'm saying I'm looking for a reason first before I go out and act on it. Because once in a while, you will get a company and you say, I can't explain that. So if I brought in growth, and I'll be quite honest, I hate three-dimensional graphs. I have no idea whether I'm coming or going, whether I'm inside the box or outside the box. But what I did was I took that scatter plot you saw on the previous page and I added a third dimension, which is growth. Now do you see where the stocks fall? So you look at Gilead, so basically you can see it falls almost, once I brought in the higher growth in Gilead and Google and Infosys, they stop looking overvalued. So this is a very unfair question, but I'm going to ask you anyway. Where in this box would be my cheap stocks? Because remember, this is a three-dimensional box now. Where would I go looking for cheap stocks? Which corner of the box? Courtney, you want to help me? Let's go dimension by dimension. You want cheap stocks. So you want low price to book or high price to book?
High.
No, you want low price to book.
Low.
You want cheap stock, yeah? So that dimension, you want a mismatch. You want high return equity or low return equity? You want a high return equity.
High,
so that,
yeah.
So you want low price to book, high return in equity, and a high growth rate, right? That's your perfect combination. So you're going to see low price to book, high return equity, low growth. You're going to be looking somewhere in that corner. And I have some bad news. There's nothing there. Am I surprised? You take the 100 largest market cap stocks. Everyone in the world is following these stocks. You're not going to find this insane bargain landing in your lap. But let's say I did this for 100 mid-cap stocks. There's a chance, right? That something, this jewel that is a... So this is the nice thing about having the data that we have now. Take 100 emerging market companies. Maybe your view is the US might be everything's okay, but if I took the 100 largest Turkish companies, who knows what's, especially in a market like this one, where people are pushing up things for all the wrong reasons, you're looking for a mismatch. Maybe it's a stock like Viacom. You know why it looks mismatched? Because in the last 4 weeks, it's down 25% because it got dumped because of that Asian equity fund crisis. There are lots of different reasons you might get a mismatch, but you're looking for that mismatch. I don't know which year this was, but no, actually this is I don't think I can do a 4-dimensional graph. I don't have the guts to do it. But the other missing dimension that I didn't have in the original graph was risk. I'm less concerned about it because these are the 100 largest market cap companies. You're not going to get something hugely risky. But my point is, when you do these comparisons, you have to be careful that the missing variables you have don't explain what you're finding as cheap or expensive. So the stocks that look cheap might just be risky stocks or low growth stocks. The stocks that look expensive might just be very secure earnings with high growth. And you're trying to make sure that that is not what explains away the difference. And just to final wrap up, in January 2010, because of these 100 stocks, and I said, you know what, I can see return equity matters. I can see risk matters. I can see why growth matters. Even though I can't bring them all into a same graph, in a regression, I can bring them all in. So let's take a look at this regression. First is when I bring them all in, so basically these are 100 largest market cap stocks, the R squared is 67%. That's actually not bad. 100 largest market cap stocks from different sectors, I'm explaining 67% of variance. So I'm feeling pretty good about that. My base is 0.41. That's a build from it. I was going to use the beta, but take a look at the T statistic on the beta. What are you getting? The market saying, at least in the 100 largest market cap stocks, there is really no variation in price to book based on risk. The market's not making a big distinction, which means if I were really wanting to use this regression, you know what I'd do? I'd take beta out of the regression. Why have noise in your regression for no reason at all? But the growth and ROE clearly do matter. Every 1% increase in my growth rate increases my price to book by 0.09. Every 1% increase in my return equity increased by 0.10. I could be a one-person hedge fund with those 100 stocks, right? I could run the regression, get predicted values. And I'm not saying this is what quants do, but if you think about what quantitative, this is becoming a big deal with access to data. What quants do is take the data, and they don't stop at these simple regressions. They hire statistics geeks who go they do nonlinear regressions, they add special variables. But the access to data is their starting point. And the questions they're asking are not about value, they're about pricing. So when you see quant portfolio managers, they're pricing people. They've bought into the pricing mission. They're now using the data to do it better. January 2020, before COVID, I did this. I'll send you the 2021 and what it looks like now. And so this was the start of 2020. I wanted to see what looked cheap and expensive. Kind of interesting mix of companies show up. Some you expected, right? There's Tesla. Are you surprised to see it be overvalued? Yeah, given its fundamentals. But second is Netflix, another high flyer. Lowe's and Lilly. Now I didn't expect these two to show up this far above the line. You know what I would do? I wasn't interested enough to try this. I would go take a look at why Lilly's price to book ratio is so high. You know what probably is causing it to be high, right? Both Lowe's and Lilly's had big buybacks leading in, which lowers the book equity, makes your price. So it's not the same reason Tesla's price to book is high. Tesla's price to book is high because people are bidding up the market cap. Lilly's price to book is high because you've lowered the book value of equity. In fact, there wasn't a single stock that fell below the line. I think the closest I got was, Vertex and so those are the closest to being undervalued, but nothing fell below the line. This is the start of 2020. If you want to do a March 2021 or April 2021, hey, this will take you 15 minutes to do in Capital IQ. Just go look for the 100 largest market cap stocks. You can either directly take the Capital IQ's price to book and return equity and run the analysis yourself, or you can do market cap, book value of equity and compute price to book and return equity for the companies. But you're going to see how closely the two track together. So beverages, we've looked at telecom, we've looked at banks, we've looked at the 100 largest market cap stocks. I've been fired at every job I've had. Now I'm the trucking analyst. Boring business, but I guess this is the last one left. So I'm going to show you the EV to EBITDA multiples for trucking companies. This is again way back in time, but I want you to kind of focus in on the company I'm going to recommend as a buy and think about the questions you'd like to ask me. Remember, I showed you the drivers of EV to EBITDA, tax rate, reinvestment. So keep that in line because I'm going to be a broker. I'm going to call you and say, hey, do I have a stock for you? It's Ryder Systems. You heard of Ryder trucks, right? They rent them to move stuff around. So it's a fairly well-established company. And the reason I like it, it's trading at 2.81 times EBITDA. You're saying, why don't you pick KLLM? I don't know. They're so obscure. Nobody knows about them. Ryder trucks, everybody's heard about. I like them because they trade at a low EV to EBITDA multiple. I'm still on the phone. You're a skeptical investor. David asked me the questions. What are the questions you're going to put to me as an analyst to make sure I've done my homework?
So I guess first I'd ask about reinvestment and whether they have a higher reinvestment.
You zeroed it because we asked about tax rates. I would have been evasive. Tax rates are roughly the same. These are all US companies. If you asked me about cost of capital, roughly the same. I'm glad you asked about reinvestment because there's something very interesting about the way trucking companies reinvest that makes them unique. They don't do reinvestment every year. They replace their entire fleet almost every few years. Why? Because they get bigger discounts if they do the whole fleet at a time. So if you ask me about reinvestment, I could say they reinvested very little last year, which is a good thing, right? But then the follow-up question you should probably ask me is, how old is your fleet? You see why that matters? If I have a really old fleet, I'm going to look cheap until I won't. And here's what's going to happen. You buy my stock at 2.81 times EBITDA, I have a really old fleet, and 6 months from now, you're going to open up the Wall Street Journal and you're going to see a news story that Ryder Trucks has just raised $10 billion in either new equity or new debt to do what? To replace their entire fleet. Overnight, your 2.81 times EBITDA is going to blow up to 4.5 or 5. It is reinvestment here. And all you needed to do to figure out that this was actually from an actual buy recommendation on Ryder Systems. Because I went into each of these companies' annual reports, and every one of them reported their average age of their fleet as part of their disclosure. I added an extra column on the average age of the fleet. That's all I had to do. And the mispricing almost instantaneously disappeared. It turned out that Ryder Systems was looking cheap because of the oldest fleet market, which effectively meant that you have this imminent capital raise that's going to make your mispricing disappear. Remember I said at the start of this process, there's nothing wrong with pricing. What concerns me is that people are so lazy about pricing. They're not dotting their I's. I mean, this was an equity research analyst. This was his sector. The fact that he could not bring that additional variable into the analysis is telling in terms of how sloppy pricing becomes. Lauren?
Yeah, I'm curious because reinvestment always trips me up a little bit. What if they reinvested in a new fleet of vehicles that were fully electric and then they would be able to see cost savings on their margins?
That'll be great. That'll be great because then what will happen is you have two things. Could you mute yourself because I can hear myself back? Sorry. Now, there are two things that will change it, right? One is you got this reinvestment that's a bad thing, but that reinvestment is going to lead to better margins, which is a good thing. And the net effect will then be that your EV to EBITDA could actually go up even more because of that improvement in margins, which also tells you that when you do these pricing, that you got to bring in some measure of what's going to happen in the future. So if you think Ryder Systems is best positioned to do this, you say, look, I'm going to buy the company, notwithstanding its reinvestment. And I'm doing it not because its EV to EBITDA is low, but because I think its margins are going to improve in the future. So I think that by bringing in some measure of the future, and what do you think this company will do, you can essentially bring that into your pricing. You're not doing it in the same way you'd have done in a DCF, because I think you're still doing it more completely in the DCF, but you're doing it enough that you can bring those, Your dreams, your fears can all be built into the pricing in some variable or the other. So it looks cheap, right, a system, but basically you can see how this process plays out when you look at companies trading at, remember the rule of thumb that we talked about where, the LBO guys had 6 times EBITDA is cheap, trust me. You see the danger of just buying stocks at less than 6 times EBITDA. You know what kind of companies you're going to end up buying? Crappy companies with no future. You say, that's okay, I got it cheap. You know what's going to happen to those companies? They're going to get even cheaper. The end game here is not some recovery to a historic mean. And it's something that you need to factor in when you just buy stocks based on the fact that they trade at low multiples. We'll do one final example and we'll end for the day. This was, I'm just going to give you a sequence of scatter plots of grocery stores. Very boring business usually, right? If you think about grocery stores, what do you think about? Low growth, low margins. Boring, boring, boring. Until 2007, when you got a new player in the game that had a very different business model. It was Whole Foods entering the business. What was different about Whole Foods? They sold organic stuff at high prices, big margins. It had growth. So when you looked at Whole Foods in 2007, it was clearly an outlier. So if you plotted Whole Foods against the rest of the sector, it looked overpriced, right? It just looked much, but you'd have been crazy to sell short on Whole Foods and saying it's overpriced, but it did look overpriced, even if you brought in the higher margins. So in 2007, I used the margins at Whole Foods at 3.41%, which is about 3 times higher than the typical grocery store's margins to come up with a predicted price to sales. But that predicted price to sales was actually much lower than what it was trading at. So 2007, notwithstanding all its good stuff, Whole Foods looked significantly overpriced. 2 years later, I looked at the grocery sector again. There's no Whole Foods above the line. In fact, take a look at where Whole Foods has dropped. It's almost dropped to being the most underpriced grocery company in the market. So 2007 was the most overpriced. It's now become the most underpriced. In fact, in 2009, when I did this, my predicted price to sales was 0.36. They were trading at 0.31. They've gone from being overpriced to underpriced. 2010, I did Whole Foods again, and it's back to being overpriced. I don't want to be, make light of being bipolar, but this is a manic depressive stock, right? Basically, it's being either massively overpriced or massively underpriced. And in fact, in 2000, if you go through time, you'll see the mispricing start to disappear. I'm making a bigger point. You know why people were mispricing Whole Foods in 2007? Because they'd never seen a grocery store like this one. And grocery analysts had no idea what to do with it. So they were screwing up big time in both directions. Every time something good happened, they overshot on the price. Every time. But over time, they learned. And by the time you got to 2012 or 2013, Whole Foods was well in the pack. Your best chances often on investing in disruptive companies is very early in the process because people have no idea what to do. And that process can last a long time. Tesla, if you're a typical auto analyst, you have no idea what to even do with Tesla still. It's so different from every other company. Today, Whole Foods is of course part of Amazon, but by 2015 or 2016, analysts knew how to price Whole Foods. They were able to bring it in. You're saying the game's over. Not necessarily, right? This was in 2015, a new game in town. That's when Sprouts got listed. And you saw it do exactly the same thing that Whole Foods did early in its life. The learning was quicker here. By 2017 or 18, Sprouts had fallen back towards the pack. So when you see a sector and you see companies that are new to that sector, don't be surprised to see significant mispricing early in the life of the company, because analysts really don't know what to do. They're just completely at sea. And that's the reason we do valuation early in a company's life cycle, because that's when the pricing mistakes are likely to be largest, and perhaps we can take advantage of those wild swings in the prices. I'm going to end with that. Any final questions? None? Okay. I will see you on Monday.